So for those of you who are new to this channel, you can actually follow me on Instagram. In case you have any queries, you can definitely ask me that. DM me your queries. Just give me a couple of weeks time because I receive a lot of questions, but I'll definitely get back to you. My ID is st_pyi, and you can certainly scan this code and directly follow me on Instagram. Back to another weekly episode. So let us quickly analyze whether we are very close to the bottom, at least for this particular quarter. And I'll take you through some data points so that we can understand this better. So the first data point that I would like to pull out, each chart that you see will have similar data. The number in the bracket denotes the total number of stocks in the market, liquid stocks, the year 24-25, and this is the corrective data in the market, which means if you look at the x-axis, minus 75, minus 75, minus 65, minus 60, this means how many stocks have corrected, minus 40%, minus 35%, minus 30%. That is from recent highs. So if you look at 2024-2025 corrective data, which is this particular chart, we are in correction since the month of September, and broader market has moved from 24,600 to 2904. The latest data, I think, just pull out 1% lower, something around 20,700. So if you look at the corrective data, in this particular phase, there are 147 stocks. So you can take this number and divide it by this particular number into 100 to get the percentage data. For example, 147 would roughly mean about 7-8% stocks that have fallen about 45 to 40%. That is minus 40 to minus 45%. About 182 stocks, roughly 10%, have fallen between minus 35 to minus 40%. About 190 stocks, about 9.5% stocks in the market have fallen between minus 35 to minus 30%. 192 stocks, roughly 10% stocks, have fallen between minus 25 to minus 30%. So if you club this together, that is the bulk of the selling, including this, you would see that this is about 35 to 40% of market that has corrected between minus 20% to minus 45%. This is a big correction that has happened in the market. And yes, we may have more time and price correction left in the market based on whatever we have discussed in the last 4-5 weeks. In fact, you need to go back to my 2025 market outlook video to understand why things have happened the way they have. So in this correction, you have about 30-35% of the market that has fallen between minus 45 to minus 25%. And if you compare this with previous corrections, that is when you will understand where we are currently in the corrective cycle. For instance, in the 2022 June corrective phase, where total number of liquid stocks were roughly about 1900, back then about 135 stocks had corrected between minus 10 to minus 20%. But the bulk of the correction, so if you look at this number, approximately 300 stocks had fallen between minus 30 to minus 40%. About 240 stocks had fallen between minus 20 to minus 30%. And about 168 stocks fell minus 40 to minus 50%. So the 2022 June correction, which was a bull market correction, where majority of stocks did not violate the 200 DMA, 50 DMA, that corrective action was very different from what you see today. Today, if you see, it is a much deeper and a much broader kind of correction that has played out. So back then, if you look at the data in terms of Nifty 500, so this was the entire corrective period where the Nifty kept going up and down and the stocks kept falling, but majority of stocks still held out well. There was a clear leadership in the market, that is between September 21 and something like June 2022. Actual correction ended only in March 2023. But the point being that the corrective price action was painful. Can you see these V-shaped recoveries? As of today, if you look at our market, we've had one V-shaped recovery here, then we've again had a corrective kind of price action. So maybe towards the end of Feb, we'll make a dash towards 50 DMA or maybe closer to these pivots. You get an illusion that things have worked out and eventually the market is put in a bottom. But time and price corrections are always complex. If you look at the 2022-2023 correction, it was both a price correction, then the market retraced back, and this price correction became time correction. Again, you had a price correction, again price moved back to the same level it was a couple of years back or maybe 2-3 quarters back. So this price correction again became time correction. For the time being, in this particular cycle, you're seeing more of a price correction playing out, and that is why the extent of damage in the market is amazing in terms of what may happen in the next 2-3 years. This is the correction that a lot of people were waiting for. But the thing is, whenever you see such corrections playing out, it becomes incredibly difficult for people to go inside and put in money. If you look at the next corrective cycle that played out, that was between 2020 March and Feb, which was the COVID fall. Again, the number of liquid stocks back then was 1650. This time, the price damage was actually extensive because it was a V-shaped kind of a fall in the market. So, number of stocks that fell between 50 to 60% were 128, roughly 7%. Then about 100 stocks fell between 60 to 70. About 100 stocks fell between 40 to 50%. Then 65 stocks fell about 30 to 40%. About 23 stocks between minus 20 to minus 30. So again, I've taken the liquid data, not stocks that usually move in circuit, because that distorts the breadth data a lot. But this kind of price action in terms of damage was extensive, and that actually happened in a very short period of time between Jan to March. So this was the kind of fall that actually played out, and the market stabilized and a wonderful bull market kind of resumed. The next cycle was the 2018 cycle, where the small mid micro cap space was decimated. And back then there was 1600 liquid stocks. It's very similar to what we are seeing today in terms of distribution of stocks having corrected a certain percentage point. So back then 136, about let's say roughly 10% stocks had fallen between 20-30%. Again, another 10% between 30 to 40%, and about 100 stocks between 40 to 50%. But the bulk of selling was between minus 10 and something like minus 50%. So if you go back and check the data, currently we are very similar. It is just that I would tell you that the current corrective price action is actually more damaging than what happened in 2018, because the base of the market in terms of corrective price action, the number of stocks that were uniformly falling 20-30%, are much higher this time around. So this was the 2018 corrective price action. We had a fall, then a recovery, again a recovery, then a fall. It was a very complex kind of a market. But with each chart that I've shown you, whether it is the 2018 corrective cycle, 2020 corrective cycle, 22 corrective cycle, or even the current corrective cycle that you're seeing, you'll always see that market, after facing challenge in the last 2-3 months, always tries to stage some form of a comeback. And that is when, if you're stuck into some illiquid stocks, you can attempt getting out. But reversal or counter trend moves will always happen in the market. Whenever you are stuck in a corrective phase, obviously it seems like there's no end to it, but a turnaround always happens in the market. That is what you learn from history. The 2016 cycle, after the 2014 and 15 kind of a bull cycle that played out in the market, had 1300 liquid stocks. Look at what happened back then. About 100 stocks were down 40 to 50%. 150 stocks, about 11% were down 30 to 40%. About 130 stocks, roughly 10% were down between 20 to 30%. So the bulk of the correction that played out was between 20% and 50%. Again, this was the kind of corrective cycle that played out. If you look at the 2016 corrective price action, again, we had a fall. This was the day I think the US elections were announced, if I'm not wrong. Donald Trump for the first time became the president of the United States. We had gapped down, then closed higher, then a couple of days back we again reversed everything. And such corrective price action in the market caused severe damage across the board, that is mid, small and large caps. This time around, if you're looking at the market, you are seeing more corrective price action in the small, mid, micro cap space, whereas the large cap space is relatively doing okay, mainly because we have valuation comfort there, and none of those stocks or pockets within large caps have given crazy returns that the SMIDS space, which is the small, mid, micro cap space, gave you. So in this particular cycle, can you buy anything, and if, how you would approach that? See, there are three patterns I'll show you. All right, I haven't put out the price scale, I haven't put out the name for obvious reasons. But there are some stocks in this market that are doing this. They're forming a contraction and attempting to break out. This particular chart, if you see, has already broken out. Now remember, in this market cycle, everything is falling and everything will fall. So it does not mean that if you see such candles, you go out and commit a lot of money, because easily price can have a retracement about this level, stabilize here, and while market improves, then it can move higher. So you need to have cushion. You can only get cushion two ways. Number one, put your initial position size small, or if you're buying with your original position size, you have to space out your bets. You cannot enter complete position size here. Split it in 10 parts, put that money across, let's say 30 weeks or 20 weeks or 10 weeks, whatever your risk profile is. The second pattern are the stocks that have not yet broken out but are still setting up in a contraction kind of structure. Actually, this broke out and has come back. So this is the third pattern that I'll discuss. But there are some stocks that are already doing this, are threatening to break out, but are not breaking out because of the broader market. So again, such charts should also be in your watch list. And the best part is you will not find 500 names that are exhibiting such structures. There are handful. And when I say handful, when I went through the charts this week, I could find 67 stocks in the market that are exhibiting this. That is the kind of opportunity you have. Cannot go in blindly, but keep these stocks on your watch list because these could potentially be the next winners in the market. Again, look at the contraction here. This has lasted over 3-4 years and now it is attempting to break out. It can easily come back to the midpoint of this range. All right, the midpoint of this range usually provides support to the price. And in this environment, whoever has entered here, market will shake these people out. It will pull back, probably a retest of this 30 weekly moving average. And then over time, it heads up. So these three structures are the structures that you should be looking at. Not stocks that have fallen 50%, not stocks that were at 1,000 now trading at 200 or 300, because there are plenty of stocks that have done that. There are plenty of stocks who were previous cycle winners. They are not going to get back to the same levels for the next many, many, many years. Always remember this. Previous bull cycle leaders rarely get back to their previous level. That is so soon. It is always going to take you time. If you remember in the 2003-2007 bull market, the likes of Aban Offshore, the likes of ABB, the likes of Unitech, the likes of DLF, Larsen and Toubro, they took at least 10 years to get back to those same levels. In 2011, 2013, the kind of rally that played out in FMCG, pharma, and auto sector, it's playing out again after 10 years. So whichever pockets had outperformed in the year 2021, 2022, 2023, those pockets are not going to outperform again. There are newer pockets that will set up in the market. Which spaces are falling less today in the market? It is some bit of technology, nifty digital, nifty financial services, private sector banks, some pockets of healthcare and pharma. These are the pockets that are falling less. But these pockets are still in lower high, lower low structure, which means these pockets are outperforming the market currently by falling less. They are falling with the market, but they are falling less, which means they have a potential to outperform in months to come. And if the market stabilizes, perhaps these are the stocks and the sectors that are going to take the market higher. So before I move to next section, I'll quickly summarize. These are the three patterns you can track. Whichever stocks you find that are doing this, you need to put it in the watch list. The way the market is currently, most of the breakout stocks are also going to see retracement, which means you can get better opportunity to buy such stocks even at lower level. Have a slow and gradual approach, but definitely buy in the market. If you originally buy 100 shares, buy 2 shares and see what happens, but definitely take advantage of such structures that are setting up and have the potential to be the next leaders in the market. These are your best bets. Yes, there are stocks that have fallen from 1,000 to maybe 400 and they are setting up, but those stocks will have resistance at each given level when the price tries to rise. There are a lot of people who are stuck at higher levels, don't forget that. That is why I prefer stocks that are setting up or are breaking out or have broken out and are again coming back and testing the previous breakout level. All right. So now I'll come to the section of the risk of dollar. I'm talking about dollar index every week, and for some of you who are new to this channel, go back the last 4 videos and check the sequence in which I have explained certain things. That is when you'll get the link of what is currently happening in the market. The risk in the market still is of dollar index forming a long base and breaking out. This is a valid breakout in dollar index, and we have retraced from 110 to 107 level. At the time of recording, it is at 106.9, and yet we are not seeing any sustainable rally or a bounce emerging in the entire emerging market basket. It is not about India. Entire emerging market basket is facing a lot of pressure. Our currency went up to 88.5, and last time I checked it was at 86.8, and yet we are not seeing any bounce in the market. This just tells you the kind of damage that has happened in the market in terms of sentiment. I don't think people want to buy, and it is understandable, but that is the nature of the market. In October or September 24, when you wanted to buy stocks 20% lower, 25% lower, 6 months down the line or probably 4 months down the line, when the market is eventually giving people that level, people don't want to buy. They don't want to buy because, again, fear is dominating currently what people do on day-to-day basis. So dollar index, yes, remains a big threat. What would be amazing for the market is if dollar index again moves back to the range of 99 to probably 106 or 105 and stays there for the next 2 3 years. Again, this will only happen probably after April May. I've given you a time kind of a guideline in terms of when the market can start stabilizing and moving up for a sustainable kind of trend. That is post May June only, because by then the policies of the new US government would be clear, dollar would stabilize, a lot of things would materialize in the world. So that is when, until then, this corrective phase will continue. Now comes to the bottom formation cycle. Again, this I have taken from William O'Neill's book. That is what he has taught about how bottoms are formed in the market. And I'll try and estimate where we are today. See, the first phase is when the corrective price action has kind of continued for a long time and people get a feeling that the fall cannot happen more from the current levels. Then the next stage comes is, this is after a prolonged correction has happened. The breadth damage continues in the market. Previous leaders keep falling. Portfolios keep seeing pain. Every time that the market opens up, during the day, it closes near the low point of the day. Portfolios fluctuate 5-6%, but again, after 10 days, they're down 5-7% from where they were last week. So I estimate that we are somewhere in this breadth damage phase. We still have some bit of panic selling remaining in the market. I don't know before the panic selling phase whether Nifty stages of one kind of a sharp 7-8% recovery and then this phase comes. I'm a bit unsure about that. But I think we are currently in a phase where a lot of breadth damage is happening. The cannot fall more phase has ended because around 24,000, 23,500, there was a feeling that the market is approaching levels where a bounce can come by. And I rely only on what I'm thinking because that is what I was thinking here. But then the market kept moving lower. Now we are in a phase where unbelievable amount of breadth damage is happening. Exactly 1.5 years back, we were in a phase where number of stocks above something like 200 DMA or a 30 weekly moving average were about 90% stocks were above that. And today we are in such a phase where 94% stocks are below something like 200 DMA or 30 weekly moving average. That is the kind of breadth damage that is happening in the market. The third phase would be panic selling. So this, I think, either we'll get it in February this month or probably we'll get this in May, June, July, somewhere during that phase when Nifty has a rally of about 7-8% and then we again fall. And then the last phase of bottom formation is always trigger. It is always trigger, guys. Without a trigger, bottom does not form. And if you look at the previous cycles in our market, if you look at Nifty 500 in December 2016, the trigger was actually Donald Trump getting elected. Yes, it played out after some bit of time, but that was the trigger for emerging markets because US market was in a huge bull run. Dollar index over time started coming down. Commodity prices started stabilizing, and that is what happened. If you look at the 2018 cycle, when did we start seeing a really strong bull market? It was after the corporate tax were cut in this particular cycle. Yes, that particular recovery was kind of interrupted by the event of COVID that happened, I think 1.5 years or 14 months after the corporate tax rate cuts were announced. But there were pockets that it started showing a lot of momentum. If you look at this particular cycle, COVID, when did the bottom form? All over the world, central banks and governments stepped in and put in unbelievable amount of liquidity in the system. That is when it happened. And if you look at the 2021 2022 kind of bottom formation that happened in the market, it again came on the back of Federal Reserve and the actions it took, and the US market started turning around, and that is when India also started doing really, really well. So if you look at this phase, a couple of weeks back or the last two episodes, I've made videos about why a small mid micro cap rally is still far away, and you can see the kind of damage that is happening. This damage in the broader market will not end until and unless we have a strong trigger in the market. I would tell you one thing, our macros, whether it comes to fiscal deficit, as we discussed in the last episode, the fiscal side and the monetary policy side is near perfect for a market rally or a sustainable market rally. But currently we are facing outflows, that is, all emerging markets are facing massive outflows in the market, and money is heading back to maybe safer assets because you're seeing gold and silver doing well, US equities are doing well, the fixed assets are giving you relatively risk-free returns as opposed to what emerging markets are giving you. So the global environment for emerging markets is not favorable. And until and unless something turns, this zigzag kind of movement, market making new lows after every 15 20 days, this kind of phase will continue. What is outperforming currently in our market is clearly large caps. There are sectors in the large caps that have not done well in the last 3 4 years. Those stocks are setting up. I'm giving a big hint. See which stocks have not done well within the large cap nifty 50 nifty 100 space in the last 3 4 5 years, and see if some of those stocks are attempting to form the pattern that I explained. Because a lot of stocks, lot of large cap stocks are actually trying to set up. That is what I can see. The trigger but has to come over time. Remember, India has done so well in the last 2 3 years that it's going to take some time for price to digest whatever gains have come out. So time and price correction is what is going to continue, and you just have to take it 1 week at a time. Whatever stocks you want to buy it in a super gradual slow manner. Market is not going anywhere. All right, so I'll see you again next week. Take care and be safe.